So the thing is that I think the holy grail of investing that I have figured out so far is to have partial ownership of businesses that can grow and compound for very long periods of time. Where the business has qualities which allow it to increase intrinsic value over a period of time. Cash flows are very stable. Cash flows are more stable than NVR or AutoZone. It's a very predictable recurring revenue business, which neither NVR or AutoZone are. And so when you get those type of characteristics where a business is operating like clipping coupons on a bond and the stock is really cheap, you can get incredible results.
Don't forget to like and subscribe if you haven't done it already.
There's a relatively famous investor in India, passed away recently. You may have seen the news even in Thailand, Rakesh Jhunjhunwala. And Rakesh was a billionaire several times over. He never managed money for others. He only really managed money for himself. And he actually started with nothing. He actually borrowed about $20,000 at about 18% interest from some individuals to get going. When he passed away recently, he had a few $1 billion to his name. And Rakesh was he was kind of a split brain in the sense that he did a lot of day trading and rapid fire in and out trading. But at the same time, he had some positions that he held for decades, never touched them. So for example, he had made an investment maybe about 25 or 30 years ago into a company in India called Titan. They actually are a jewelry retailer. They used to be a watch retailer, but now jewelry manufacturer and retailer. He had put about 3 decades ago, about 4% of his net worth into Titan, and he never really touched it after that. He also said in one of the interviews that he actually never visited a single manufacturing plant of Titan over that period. I think it represented about close to half of his net worth when he passed away. So, something that was a 4% investment became 50% or more of his portfolio, and the rest of his portfolio had also done well. So this was quite a significant return. There was another company, a pharmaceutical company, Lupin, which he'd also held for a very long time. And there was a third one that he very deeply regretted till the end that he sold. So he had made a few times his money on that. That was Crisil. It was a credit rating agency, the best credit rating agency in India. So the thing is that I think the holy grail of investing that I have figured out so far is to have partial ownership of businesses that can grow and compound for very long periods of time, where the business has qualities which allow it to increase intrinsic value over a period of time. And usually these companies have some attribute that allow us to maybe identify them. One of the attributes that they tend to have, they tend to be run by or founded by kind of fanatical leaders, maverick leaders who don't really fit the normal mold. They kind of appear somewhat unusual there in their makeup. So like, for example, in the United States, we have an airline called Southwest Airlines. Southwest Airlines has done extremely well. I mean, it's been around for 50 years, and I don't think they've except perhaps during COVID, they never lost money any year. And they actually pioneered the low-cost carrier movement around the world. A lot of companies around the world, Ryanair and Asia Air and so on, they all copied Southwest model, which Herb Kelleher came up with. What Southwest was trying to do is they were not trying to compete with other airlines. They were a short-haul carrier. And Herb Kelleher said that I'm trying to compete with the driver trying to drive in his car to between two cities, 200 or 300 miles. And he said, I want to make flying cheaper than the person putting gas in his car and going, one tank of gas to get to another city. And so he focused all the cost structures of Southwest to make it attractive for that particular type of a customer to find Southwest attractive. And when he was able to make that attractive for that type of customer, other airlines just couldn't compete with him. Their cost structures were designed to compete with other airlines, not with people driving cars. And so Southwest got a kind of sustainable advantage. And for a very long period of time, they compounded at a higher rate than Berkshire Hathaway from the 70s on from there. One of the ways, so these multi-baggers, companies that go up 50 times, 100 times, 1,000 times in value, they can come in different stripes and colors, but they do have some commonality and they do have some common frameworks that can help us identify. One of the frameworks that is actually easy to screen for and easy to look for, what I would call Uber cannibals. So these are companies that are very aggressive about buying back their shares. Typically, these companies issue no dividends and they are pretty much plowing back sometimes more than 100% of cash flows or close to 100% of cash flows into buybacks. And there is something very unusual and magical and actually non-linear that happens when you do buybacks kind of pace over a few decades. So for example, we have a home builder in the United States in the East Coast called NVR. NVR basically for the last 28 years has plowed back almost 100% of their cash flows into buybacks. They don't issue dividends, they only do buybacks. The one thing they changed in their business model about 3 decades ago is most home builders, what they would do in the United States is they will have a lot of investment in land. They buy land banks and then they develop the homes and then they get rid of the land and they keep buying more land. What NVR did is they changed that approach to being just in time. They basically went to landowners and got options, bought options to buy their land. So if a piece of property would cost $10 million or $30 million, they might put up, $200,000 or $300,000 or $500,000 to have the option to buy that land at a fixed price over some period of time. And that way they don't have capital tied up. Then when they need the land, they exercise that option. So once they go to land not being a factor of production that they need to invest in years in advance, it becomes a very capital light business. And it becomes a business that generates very high returns on equity. And home building is a cyclical business. It goes through ebbs and flows. But because they don't have a lot of fixed costs in their model, and because they don't have a lot of capital in their model, all they do is like when they hit an air pocket, like, demand is low and sales are low, they'll stop the buybacks. They won't have earnings, so they'll stop the buybacks. And from 94 till now, that only happened 2 years during the financial crisis, 2008 and 2009, when housing demand went down a lot in the US. So NVR basically has bought back 75% of the shares outstanding in the last 28 years. They used to have about 16 million shares outstanding, and I think now it's about 3.5 million. And the shares used to be, and they don't split the stock, so actually it's really easy to look at their returns. 28 years ago, the stock was $6 a share. And it's gone down a little bit in 2022, but at the end of 21, it was about $6,000 a share. So it went from $6 to $6,000 over a 28-year period. It wasn't a 100-bagger. It was a 1,000-bagger over a 28-year period. It wasn't a company designing software or something which you would normally think of as a high return on equity business. They're just building homes. And basically all their incentives and everything to management is around the return on equity. all of that. So it's all very focused in that area. There's another company called AutoZone, which is a auto parts retailer in the US. And AutoZone, again, has over the last 3 decades had a similar story to NVR, where they basically have no dividend. And in their case, they're growing, they've been adding more stores. But again, it's a high return on equity business. There isn't much equity in the business. Its stock has gone up about 200 times in the last. So basically, when companies do buybacks, buying back 3%, 5% of the shares, that doesn't do a whole lot. But if they do it for 20 years in a row, and that share count goes down 80%, now it starts getting interesting, because in the case of NVR, for example, in the last 28 years, the revenues went up 10 times. Okay, so the stock went up 1,000 times. The revenue only went up 10 times. And if you look at inflation over this 28-year period, adjusted for inflation, it may be much less than that. So they didn't have extraordinary growth in terms of the top line. What they did have was the market recognizing that this is a compounder, and the market took the multiple really high. Stock trades like 40, 50 times earnings, and maybe 20, 30 years ago, just be, single digit multiples and so on. So they got a pop because of the consistency, and then so on. So one can screen for these types of businesses relatively easily, right? Because you can look at share counts and you can see whether, and once you see that a company doesn't issue dividends and the company is consistently buying back shares, and the most important thing is the business model needs to be sustainable and enduring. So we can look at the business, and it is not that difficult to tell what is a great business, what is a good business. That's not really difficult. It's more difficult to tell what is a good investment, but to actually tell what is a good in business is not very difficult, because what you're looking for is, does the business generate above average returns on equity without using much leverage? Is it able to grow? Does it have some enduring competitive advantage over its competitors? And what is the secret sauce that makes it keep going year in and year out? So if you study a business like NVR, or you study a business like AutoZone, it would take some time, but you would be able to figure out what is the enduring advantage these businesses have. When you screen for these types of businesses and then drill down on the ones that have this type of a fanatical approach, there's very few of them that have this type of fanatical approach, right? Because most managements, generally speaking, are not great capital allocators. They don't understand capital allocation really well. And buybacks are kind of weird from a management perspective. They kind of look like cash leaves your door and you don't really see anything happen when the cash leaves your door, but it happens over a period of time. So I think that the multi-baggers can come in many shapes and sizes. One of them that is an important one to look at is the ones that have understood the importance and power of buybacks. And once they understand that, and if the business model is very stable, then it can be a tremendous advantage. I was speaking to Abub just before we started our recording, and he brought up that I've mentioned in some previous talks a company in Turkey called Resas Logistics. And Resas has never bought back any shares, right? And this was a business which I invested in 2019. And at that time, the market cap was like around $20 million. And the intrinsic value was probably, liquidation value was probably 700 or 800 million. Intrinsic value was probably over $1 billion. I told the management of Resas that, look, it's almost impossible. You guys are really good capital allocators. You have a very good nose for how you do deals. It's almost impossible that you can find anything to do which would be superior to buying back your shares. because you're buying back at like 3% of liquidation value. I mean, the accretion to that. But, whatever I said to them made no sense because they've never thought about it in those terms. What they have understood now, which took them again a couple of years to understand, is that they should buy back more. They should buy more shares for themselves, and so they've been doing that, which is good, which is pretty good for them to do that. But maybe after a few years and more trust, maybe 5 years or something, we may, because that business has the qualities that we look for. They are leasing warehouses, and they're like the number one warehousing company in the country. 99% leased, 10-year inflation index leases. Cash flows are very stable. Cash flows are more stable than NVR or AutoZone. It's a very predictable recurring revenue business, which neither NVR or AutoZone are. And so when you get those type of characteristics where a business is operating like clipping coupons on a bond and the stock is really cheap, you can get incredible results. But it takes time. It takes time to build trust and convince management and so on. And we'll do well even if they never do any of that. It's just that we would do exceptionally well if they did something. So that would be fine.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.